Hello there. Welcome to this video. This video is a continuation of our discussions after talking about financial performance and after talking about working capital management. Those are actually operational matters, and those are often called lagging indicators. We see what we've done, we see where we've been, we see where we are at. And sometimes lagging indicators do allow you to take corrective action. But more importantly, we need to look at leading indicators. An example of leading indicators is to calculate the company's cost of capital, which is the required return from new investments. So this next topic that we're going to talk about is cost of capital. Let me load the Excel worksheet. There you go. Now this is the cost of capital discussion as required by table 3 of our syllabus. The cost of capital issues are basically this. First of all, what are we doing here? We want to know if the company is to undertake new investment and we have got projected cash flows. How can we evaluate those projected cash flows to find out whether they give us the required rate of return? And that of course begs the question, what should be the required rate of return? As far as listed companies are concerned, listed companies go to the stock market and look at current market returns as an indicator of what the required rate of return should be. This also can be used as a benchmark to compare the company's performance with other companies in the same sector. How do we calculate this required rate of return? Well, we look at the long-term sources of finance that are listed on the stock exchange. So if a company has listed equity, we will find out what is the return on those equity shares. If a company has listed bonds, we will also find out what are the kind of returns which bondholders are enjoying. Note on terminology, the required return by equity shareholders on the stock market becomes the cost of equity for the company. The required return by bondholders on the stock market becomes the cost of debt for the company. So our discussion is often based on long-term sources of finance and the market value of listed securities. Let me work out a simple example for you. Let us say we have a company which has a total market value of 100 billion. The total market value is made up of equity shares of 60 billion and bonds of 40 billion. So basically you could say the total market value is 100 billion where the proportion of equity is 60 and the proportion of debt is 40%. Now let us say an investment banker has computed the required returns as follows. He has found that equity shareholders require a return of 15% currently on the stock market, and the bonds are paid 6% pre-tax. 6% pre-tax means before calculating any tax benefit of paying interest. Dividends on equity are a distribution of profit, so there is no tax benefit to a company of paying dividends, no tax impact at all. But when interest is paid on bonds, this interest can be charged to tax. So if the applicable tax rate is 25%, we can actually calculate the after-tax cost of debt as 6% multiplied by 100 minus 25%, because we are going to get a 25% rebate on the 6% interest that you paid. So effectively, the cost would be 6% multiplied by, in this case, 75%, because tax is 25, and the net cost of debt in this case is 4.5%. So for a company that has equity of 60 billion and bonds with market value of 40 billion, and we know that the required returns on the market for the shares are 15%, and the bonds require a 4.5% return. If this is our capital structure, what should be the cost of capital? What should be the required return on the finance of this company? Well, the answer is it would be the weighted average of the cost of equity, which is 15%, and the cost of debt after adjustment for the tax benefit at 4.5%. Since proportion of equity is 60-40, or for convenience you can put it as 0.6 and 0.4. The reason why I do this is if I take one value as a decimal and the other as a percentage, when I use them in my weighted average formula, the answer will automatically be a percentage. So that makes life a lot easy. So I often take the proportion as a decimal and the cost of capital as a percentage. In this case, the proportion of equity to debt is 0.6, 0.4, and cost of capital to the company we have seen is 15%. This is KE, and the cost of debt are often stated as multiplied by 1 minus T. The tax rate is 4.5%. Now, in our weighted average formula, weighted average is always proportion multiplied by value. Since the proportionate value of equity is 0.6, we multiply 0.6 by the cost of equity, which is 15%, and add on the proportion of debt 0.4 multiplied by the after-tax cost of debt at 4.5%. And how much would that give us? Let us see. That would be 0.6 or 0.6, because I'm using Excel, multiplied by 15 plus 0.4 multiplied by 4.5, and that should give me a value of 10.8%. And this is how the weighted average cost of capital is calculated. I have given you another example here of how this may be done. You should go through this and try to calculate the cost of capital and see if you can get the same answer as I did at 14.6%. I have also included a case study on Enviro Green Berhad in this particular example, so perhaps you might want to take a look at that too. Now, as far as the formulae are concerned, this is how it works. The cost of capital is often called K0. The proportion of equity is a decimal. The required return on equity is called KE, and the required return on bonds is called KD after tax. Now, in order to compute this, what do we have to do? Well, the process which I have listed down here for you is this. First of all, ask yourself, what are the listed securities of this company? What are their total market value? What is the proportionate value in the capital structure? In our example just now, the market value of equity was 60 billion and the value of bonds was 40 billion. So the proportionate value was 0.6 for equity and 0.4 for bonds. Then compute the individual cost of capital. Now there are two approaches to this. You can use the weighted average cost of capital, or you can use the capital asset pricing model, which bases required return on the level of systematic risk. I have given you an illustration of how these may be used and some formulae here. As managers doing an MBA program, you probably do not need to go into this level of detail, but it would be nice if you could go on to Google and read an article on these. A word on beta value though. What is beta? Beta is a measure of market risk, systematic risk. You see, total risk is measured using standard deviation, and Total risk can be risk individual to the firm, that is my green circle here, or it can be risk caused by market factors, which is my blue circle here. And if a company is well diversified, it will not have any individual risk because of its diversified portfolio. Therefore, the only risk that it will be affected by mainly is market risk. And the theory says that since the only risk it is affected by is market risk, investors, equity shareholders and bondholders would require compensation only for market risk, and market risk is measured using beta value. For a fully diversified company, market risk is the only risk that it needs to consider because the total risk is actually only the market risk. Now, the mathematical measure of beta is given as covariance with market returns and variance of market returns. Again, this is a nice to know matter for you. However, the important thing you should remember is this: if your company's shares, your company that is listed, the shares have a beta of 1, it means that the market risk and your company's risk is more or less the same, and you would be actually having returns very closely to the securities market line. If your systematic risk or market risk is greater than the market, that is to say, if there's any change in the market, the fluctuation in the share price for your company is more than the market, then your beta value will be greater than 1. And your required returns would of course be to the right of this vertical line 1. Vertical line 1 means 100% of market risk, and therefore it gives you market returns. Now, logic would dictate that if your risk is greater than the average market risk, then your required returns would be greater than the average market returns. If your beta is less than 1, that means the impact of market risk on you is less than 100%, then of course the returns required from your shares or bonds would be less than the average market returns. But the beauty of this equation is that it also recognizes the fact that on the stock market there may be actually some securities that are totally risk-free. That's the RF, risk-free return. So the required return from your shares or bonds is the return that anyone could get by taking no risk at all, plus your proportion or your beta multiplied by the market premium for risk. And that gives you a risk-adjusted required rate of return. Happy learning.